So picture this. You've been doing everything right. You got a savings account, maybe a high-yield one because you heard that was the smart move. You set up automatic transfers, so a little chunk of every paycheck disappears before you can spend it. You're not blowing money on nonsense. You're not eating avocado toast for every meal. You're actually trying. And for a little while there, it felt like it was working. You were watching that number go up, and the interest rate was actually decent for the first time in years. You were like, okay, finally, this is making sense. And then you start seeing the headlines. The Federal Reserve this, interest rate decision that. And you think, okay, should I be paying attention to this? Because honestly, most of the financial news out there feels like it's written for people who already know everything. And if you don't, you're just supposed to nod along and hope it works out. My name is Emmy, and I spend way too much time thinking about money, the systems around money, and honestly, why the people who need financial information the most are usually the last ones to get it in a way that actually makes sense. I've watched so many people make really avoidable financial mistakes, not because they were careless or irresponsible, but because nobody ever explained the mechanics clearly. And the Fed rate situation? It's one of those things that sounds like background noise until it isn't, until it's quietly reshaping your financial life and you didn't even see it coming. So today, we're going to talk about what the Federal Reserve's rate decisions actually mean for your money, not in a textbook way, in a real, tangible, this affects your savings account and your debt and your mortgage kind of way. And by the end of this, I think you're going to look at those Fed announcements very differently, because there's a lot happening beneath the surface, and most of it, nobody explains. Let's start at the very beginning, because I think that's where most of the confusion comes from. Okay, so the Federal Reserve. Most people have this vague idea that it's some government thing that controls interest rates. And that's not wrong, but it's kind of like saying a surgeon is someone who uses knives at work. Technically accurate, completely misses the point. The Federal Reserve is the central bank of the United States. It's not exactly part of the government, but it's not exactly private either. It exists in this weird in-between space, and it has one main job: keep the economy stable. They do that by controlling something called the federal funds rate, which is basically the interest rate that banks charge each other when they lend money overnight. And I know that sounds incredibly boring and removed from your daily life, but hang on. Here's the thing. When the Fed raises that rate, banks have to pay more to borrow money from each other. So what do? They pass that cost along. Suddenly, car loans are more expensive, mortgages go up, credit card interest rates climb, and the money you have sitting in savings, well, that should go up too, because banks are now willing to pay you more to hold your deposits, in theory. When the Fed cuts rates, the opposite happens. Borrowing gets cheaper. Credit card rates come down a little, mortgages become more affordable. But here's the catch. Savings rates drop too, and they drop fast. Banks are not sentimental about this. The second the Fed signals a cut, savings rates shrink almost immediately. And here's the part that really frustrated me when I first learned it. The Fed moves quickly when it hurts savers, and slowly when it helps them. Banks cut savings rates almost overnight when rates drop, but when rates rise, they raise savings rates gradually, reluctantly, like they're doing you a personal favor. So why does this matter right now? Because we've been living through one of the most unusual interest rate environments in recent American history, and we're potentially on the other side of it. After years of near-zero rates, the Fed aggressively hiked rates starting in 2022 to fight inflation. For the first time in a long time, savings accounts were actually paying decent returns. Some high-yield savings accounts were offering 4, 5, even 5.5% APY. That was genuinely exciting, but those days may not last, and if you've been counting on that interest income, or if you've been building a financial plan around those returns, you need to be paying attention. So here's where we are. The Fed has been walking a really tight rope. On one hand, they raised rates aggressively to bring inflation down, and it worked, kind of. Inflation has cooled significantly from its peak. On the other hand, higher rates create their own problems. They slow down the economy, make it harder for businesses to borrow and grow, cool the housing market, and can tip things toward a recession if they stay too high for too long. The question everyone, and I mean every economist, every investor, every anxious homeowner has been asking is, when are they going to start cutting, and how much? Now, I want to be careful here because I'm not a fortune teller, and neither is anyone on CNBC, no matter how confident they sound. But what we do know is this. The Fed has signaled that cuts are coming or are already beginning. They've been walking this very delicate line of trying to bring rates down without reigniting inflation. And every cut, every signal, every meeting minute, it all matters to your actual financial life in specific, measurable ways. Let me give you a concrete example. Let's say you have $50,000 in a high-yield savings account at 5% APY. That's $2,500 a year in interest. That's real money. That's a vacation or a car payment or a meaningful chunk of an emergency fund. Now let's say rates get cut by 1.5 percentage points over the next year. Now you're at 3.5%. You're making $1,750. You just lost $750 a year doing literally nothing differently. And that's the modest scenario. In a more aggressive cutting cycle, you could be looking at dropping back to 2% or below, bringing you to $1,000 a year on that same $50,000. That's a $1,500 drop in annual passive income, and most people don't realize it's happening because the number in their account still goes up, just more slowly. It's a quiet loss, a slow bleed, and by the time most people notice, they've already lost significant ground.
Okay, this is the part that I think is most underappreciated, and honestly, it kind of bothers me that it's not talked about more. Because there's this thing that happens when rates are high and people finally feel good about keeping money in savings, they get comfortable. And then rates start to fall, and they stay comfortable because the account still looks fine. It's still growing. They're not losing money in any dramatic way, and so they don't change anything. Meanwhile, inflation is still doing its slow, persistent thing. Even at 3% inflation, your purchasing power is eroding, and if your savings rate drops to 2.5%, you're now technically losing ground. You're earning less than inflation. That $50,000 is worth less in real terms next year than it is today. Not because anything happened to your account, but because the world got more expensive faster than your savings grew. This is what I call the savings comfort trap. You feel safe because the number is going up, but safety and growth are not the same thing. And this is where a lot of people, including smart, financially aware people, get stuck. I remember talking to someone once, and I think about this conversation a lot, who had done everything their parents told them, saved consistently, kept 6 months of expenses in a savings account, never touched it, felt proud about it. And they should have. That's genuinely good behavior. But they'd had the same strategy for 12 years, and in that time, the financial landscape had completely changed. The habits were good, the system was outdated. Good habits with the wrong strategy is still a problem, and that's exactly what the Fed rate environment can create if you're not paying attention. So what's the alternative? What do you actually do with cash savings in a falling rate environment? Well, a few things. First, you want to understand tiered saving. Not all of your cash savings should live in the same place for the same purpose. Your emergency fund, 3 to 6 months of expenses, should be liquid. It needs to be accessible fast. A high-yield savings account is still the right home for that, even if rates drop. But beyond that, money you're saving for medium-term goals, a house in 3 years, a car in 18 months, that money can potentially work harder. CDs, or certificates of deposit, are one option. If rates are going to fall, locking in a higher rate now before they drop can actually be smart. You're essentially saying, I'll give you my money for a set period of time, and you guarantee me this rate. Some banks offer CDs at competitive rates, and if you ladder them, meaning you buy multiple CDs with staggered maturity dates, you maintain flexibility while still capturing better returns. Treasury bills and bonds are another avenue. When the Fed cuts rates, bond prices generally go up, which can actually work in your favor if you're already holding them. This is not a stock market investment. We're still talking about relatively low-risk instruments here, but they behave differently than a savings account, and in a rate-cutting cycle, that difference can matter. All right, I don't want this to feel all doom and gloom because honestly, falling rates are not universally bad news. For a lot of people, they're actually an opportunity if you know where to look. Let's talk about debt. If you have variable rate debt, credit cards, adjustable rate mortgages, variable rate student loans, home equity lines of credit, then falling interest rates are your friend. Your interest burden goes down, your minimum payments may decrease, the cost of carrying that debt gets lighter. Now, here's the move that separates people who just passively benefit from rate cuts from people who actually use them strategically. When rates fall and your debt burden lightens, you redirect that freed up cash flow. Instead of just letting your monthly payment shrink and spending the difference, you keep your payment the same or increase it and pay down principal faster. You're accelerating your way out of debt using the rate environment as a tailwind. Same thing applies to mortgages. If you bought a house at a 7 or 8% mortgage because rates were high and they dropped to 5 or 5.5%, refinancing becomes worth looking at very seriously. Now, refinancing isn't free. There are closing costs, and the math has to make sense for your specific situation. But the general rule of thumb is that if you can drop your rate by 1% or more and you plan to stay in the home for at least a few more years, it's often worth it. And on the flip side, if you're thinking about buying a home and you've been sitting on the sidelines because rates felt punishing, a rate-cutting cycle could change that calculus. Lower mortgage rates mean lower monthly payments on the same home price or the ability to afford a more expensive home at the same monthly cost. That's a meaningful shift. The point is, rate changes are not just something that happen to you. They're something you can respond to. You just have to know they're coming and have a rough plan for what you'll do when they arrive. Okay, so we need to talk about the stock market because the moment the Fed so much as clears their throat about rate changes, the market does something dramatic and financial Twitter explodes. And if you have any money in a 401k, IRA, or brokerage account, and you should, you've probably seen your balance wiggle around and wondered what exactly is happening. Here's the basic relationship. Lower interest rates are generally good for stocks. When rates fall, bonds become less attractive, so investors shift money towards equities. Lower rates also make it cheaper for companies to borrow money to grow their businesses. And lower rates stimulate consumer spending, which boosts corporate earnings. All of that tends to push stock prices up. But, and this is important, the market often prices in expected rate cuts before they actually happen. So by the time the Fed announces a cut, stocks may have already risen in anticipation. And sometimes, if the cut is smaller than expected or the Fed signals caution about future cuts, the market can actually fall on the day of a cut, which is deeply counterintuitive and just classic markets. So what does this mean for you as someone who's not a day trader, who just wants their retirement account to grow over time? Honestly, not that much should change. If you have a long time horizon, which most people under 55 do, short-term market reactions to Fed decisions are noise, they're not signal. The fundamentals of building wealth through consistent investing in diversified index funds don't change based on what happens at a Fed meeting. What does matter is this. If you have been keeping money in cash or near cash because you were nervous about the market and also benefiting from high savings rates, that equation is changing. Keeping a ton of money in savings indefinitely in a falling rate environment when you have a long investment horizon is a choice with real long-term costs. The opportunity cost of staying in cash when rates fall is real. I'm not saying throw everything into the stock market tomorrow. I'm saying make sure your asset allocation is intentional and based on your goals, not just inertia or anxiety.
This is the section I personally find most fascinating because it gets into how we actually make decisions, not how we tell ourselves we make decisions. When interest rates were near zero for years after 2008, something interesting happened to mass financial behavior. Saving felt pointless. Why keep money in a savings account earning 0.01%? So people were pushed, often without realizing they were being pushed, toward riskier assets, toward the stock market, toward crypto, toward real estate. Some people made a lot of money. Others lost money they couldn't afford to lose, chasing returns because safe saving felt futile. Then rates went up, and a different thing happened. Suddenly, safe saving was rewarding again. People moved money back to savings accounts. I-bonds became wildly popular. CDs had wait lists. Risk appetite cooled. The rate environment was, in a very real sense, shaping behavior at scale, nudging millions of people toward or away from risk based on what happened to be profitable in that moment.
And here's the trap. Most people follow the crowd. They move to savings accounts when rates are high, right when the opportunity to earn those rates may be limited in duration. They move to riskier assets when savings feel pointless, right when those assets may be inflated from everyone else doing the same thing. They're always a little bit late, following the signal instead of anticipating it. The smarter approach is to build a financial strategy that doesn't change dramatically based on the rate environment, that has a fixed allocation for your emergency savings, a fixed allocation for medium-term goals, and a fixed allocation for long-term investing. And then within those buckets, you make adjustments based on what's available and smart, not wholesale pivots, not panic moves, tactical adjustments within a stable framework. If you're primarily reactive to the rate environment, you're always going to be behind, because by the time a shift is obvious, the easy money has already been made or the damage is already done. Okay, I've thrown a lot at you, and I don't want to leave you in that zone of knowing more but feeling less capable of acting. So let's get practical. Here are actual things you can look at, because knowing what to do is only useful if it translates to real action. First, audit your savings accounts. How much are you actually earning? Log in, look at the APY, and compare it to what's available right now. High-yield savings accounts vary wildly. Some are still paying competitive rates. Some have already quietly dropped their rates. If you haven't looked in a few months, look today. Switching banks is easier than it's ever been, and even a 0.5% difference on a meaningful balance adds up over a year. Second, think about whether CDs make sense for any portion of your savings. If you have money you won't need for 12 to 24 months, a CD at a locked-in rate could outperform a savings account if rates fall. You're trading liquidity for certainty of return. For emergency funds, that's not appropriate. For vacation savings, a house down payment fund, a car replacement fund, it might be worth looking at. Third, look at your variable rate debt. Know your rates. If you have a credit card at 22% and rates fall 1%, you're still at 21%. High-interest consumer debt is not meaningfully helped by small rate cuts. The priority there is paying it down aggressively, regardless of what the Fed does. But if you have a home equity line of credit, an adjustable rate mortgage, or other variable debt at more moderate rates, pay attention to how those change as the Fed moves. Fourth, look at your investment accounts. When did you last rebalance? When did you last check that your asset allocation still matches your goals and timeline? Not to panic sell or aggressively shift, but just to make sure you're still intentional. If you had money sitting in a money market or savings account inside your brokerage as a temporary thing and somehow it just stayed there, that's worth revisiting. Fifth, and maybe most importantly, make sure your financial plan is actually a plan, not a collection of habits, not a vague sense that you're doing the right things. A plan means you know how much you're saving, where it lives, what it's for, and when you expect to need it. It means you have an investment strategy that doesn't require you to predict what the Fed will do. It means you're not caught off guard when rates shift because you already thought about what that would mean for you. I want to zoom out for a second because I think there's something important here that's easy to miss when we're focused on the tactical details. The Federal Reserve's rate decisions are not just financial plumbing, they're policy choices made by human beings trying to manage incredibly complex systems with imperfect information. And those choices have real consequences for real people, not just in the abstract economic sense, but in the day-to-day quality of life sense. When rates are high, the people most hurt are often the ones who already have the most financial stress: people with credit card debt, people trying to buy homes in already expensive markets, small business owners with variable rate loans. When rates are low, the people most hurt are often the ones who did everything right, who saved diligently, who lived within their means, who were counting on modest returns from safe investments, like retirees living on interest income. There's always someone being squeezed. The system shifts who that is, and I think being aware of that dynamic, not cynically but realistically, helps you make better decisions, because you understand why the system is creating the pressures it's creating, and you can respond with strategy instead of just stress. The people who build real financial resilience over time are not the ones who perfectly predicted every Fed move or timed every market shift. They're the ones who built systems robust enough to survive multiple interest rate environments. They had savings and investments. They understood their debt and their assets. They weren't betting everything on one version of the future. That's the real lesson here. Not to predict, to prepare.
So let's bring this back around to where we started. You've been doing the right things, saving, being disciplined, trying to be smart with your money. And the rate environment has, for a couple of years, actually rewarded that. Your savings account has been doing real work for you. That was good. Enjoy it, but don't get so comfortable in it that you're unprepared when things change. Because here's what I want you to take away from all of this. The Fed rate environment is not something that's happening to you from a distance. It's actively shaping the return on your savings, the cost of your debt, the value of your investments, and the affordability of major purchases. It's one of the most significant forces in your personal financial life, and you can either be vaguely aware of it and react after the fact, or you can understand it well enough to stay a step ahead. The goal isn't to become an economist. The goal isn't to time markets or predict Fed decisions. The goal is to build a financial life that doesn't require perfect prediction, because no one has that. The goal is diversification across savings vehicles, across debt types, across investment strategies. The goal is to know where your money is, what it's doing, and whether that still makes sense given how the world is changing. I talk to so many people who feel behind financially, and a lot of the time they're not actually making bad decisions. They're just making good decisions from a few years ago and not updating them. The habits are solid, the information they're working with is outdated. And in a world where the financial environment can shift meaningfully in 12 to 18 months, staying current is part of the work. So do the audit. Look at your savings rates. Think about your debt. Check in on your investments. Make sure your plan is actually a plan. You don't need to have everything figured out by tomorrow. You don't need to make 5 simultaneous money moves by the weekend. But you do need to stay in the conversation with your own finances, curious, attentive, and willing to adjust when the environment changes, because it always does. And the people who come out ahead aren't always the ones who knew the most. They're usually the ones who stayed awake, the ones who kept asking questions, who didn't assume yesterday's strategy would still be optimal tomorrow, who treated their financial life as something alive and evolving, rather than a box they checked years ago. You're already asking the right questions. That's not nothing. That's actually everything.